Welcome everyone. How we doing? Six, Christian. How we doing, guys? Husky, what up? How'd everybody do today? It was a pretty fun one. You guys know I love a good range. Cornbread in the house. Cornbread got to hear Miss River keep it real one time. Yeah, range days mess a lot of people up. When you're the one, and you guys know I never go hunt the breakout. Breakout tends to fail, as we see. We see it all day, every day, So on days like this, where those breakouts keep failing, it makes it real nice for me. Somebody who assumes they won't break. So I trade against it, and you tend to get nice little rippers on days like today. And it's been fun, we're up here all high on the daily chart, just kind of in this sweet little range right here. So not a ton of levels, and we basically track one level to the next level just over and over and over again, no matter the day. Uh, those levels be hitting pretty nice. That one got a little crazy there. Remember what happened that day? I forget now. It's like I was long though, so I didn't get too blown out. Oh, two back-to-back red days, dang it. Yeah, and ranges are just it's weird because their ranges are so easy, but so difficult at the same time because you kind of like I don't really know how else to say it, but you constantly bet against what the market is showing you. So if it's selling, you're looking to buy the dip. If it's ripping, you're looking to short the rip, which it's hard because me, everybody else, we all try to teach you, trade with the market, trade the way that the market is going. That's obviously frequently going to be the best way. But what I like to tell people, and this is just, I don't know, this is just kind of a simple thing. And maybe it'll help you, maybe it won't. This isn't about the lecture or anything. This is just me nonsense before the lecture. So something that I recommend people do, and I don't know if I've ever actually talked about this in a lecture, but I recommend this to people because identifying ranged movement is what's very difficult for people. And I get that. You maybe you don't, I like to look at candles. I like to look at what like candles are telling us on the day. So early in today, where I saw, a breakdown fail, I saw a breakout fail. I was instantly, okay, we're trading ranges today. No questions asked. I'm buying any dips down to once the range is set. I'm buying any dips down to the lows. I'm shorting any pushes of these up here to the highs. But a really simple way to identify a range day. Hit the hourly chart, pull up the hourly chart, look at our first candle of the day. Until we're trading outside of that, then treat it as a range day. This one's obviously kind of a big one. We've obviously had much bigger ones, but if we really look at these first, hourly candle prints of the day, we see where the movement really happens. The movement really happens when we get outside of that early range. So you can identify this super early in the day and say, what are we trading today? And if we have that trading outside of that first, hourly candle, you can do a half-hour candle, whatever works for you. But if you're having trouble identifying a good range day, then just pull up the hourly chart and give it a look. And so for a lot of people, there's something, it's just a simple way to do it. Is it always going to work? Obviously no, like we pushed out a little bit below that first candle of the day. But all of the hourly candles are ending up back inside of it. So really just look at that chart. And then when we go into the short time frames, we see a whole lot of noise right here. But really the hourly candles are going down, up, down, up, down, up. That's all they're doing throughout the day. And so it's a great way to identify a little bit of range trade heading into it. Oh, cornbread. I'm seeing your statement there that your strategy is based on moving averages and exponential moving averages. And So that is a disclaimer that I always give. I thought I was doing a lecture tonight on indicators, but we're doing it on ETFs instead. So the indicator one might be next week. But that is a disclaimer that I always, always, always give. If we're having a range day, you're going to get demolished trading EMAs because they you get too many, you cross over. So maybe you look for the dip to buy and you buy this dip, and maybe, I mean, you make a few bucks if you're scalping, but it instantly reverses down. Then again, it crosses, you want the bounce up to the EMA. So again, maybe you make a few bucks, but then all of a sudden we're buying again, we're rejecting them. When EMAs are for the most part going flat, they're a useless tool. When they're trending, when they're spreading out, when they're doing those kinds of things, they're a very, very good tool. But when you just have sideways EMAs, the people who trade really heavily with EMAs and SMAs, they hate range days. Even, VWAP's another one. If your VWAP is flat, do not expect much. And if Raphael's in here, shout out him because he saw this as well. But a really prime example of it was NVIDIA today. Look at this VWAP. The thing is flatlined. This is doing nothing. So when you see something like that, you just have to take that step back and say, okay, we are trading in a range right now. I'm going to treat it as a range, and I'm going to buy dips and I'm going to short rips. That's all we can do. But when you have something that is just flatlined like this, like we saw it, people kept trying to buy calls here. People kept trying to buy calls here. Never worked. I alerted some calls here. I took those same calls here, trimmed them off here, and then again, got in some calls again on the break of the VWAP for the little push up. That's all you're looking for. But if we are going sideways, EMA traders are getting blown out left and right. That's just the unfortunate side of it. Even one of the EMA combos that we're going to talk about next week that I have, or that I like, is this 5 and 13. So they pick up on movement very quickly. But you'll have a cross and then another cross and another cross and another cross, and the stock's not really going anywhere. And so when these things are sideways, run away. If you don't like ranges, then run away when your EMAs are going straight left to right. Welcome everybody. How we doing? Give it a few more minutes to let people show up. How'd everybody do today? Got a few more people in here now. Hope everyone had a good one. Or if it was a red one, not a very big red one. That's always the most important part. Live to fight another day is key. Well, the blue levels are just my support and resistance levels. Obviously this one's a fib, so this is off the daily. These are the fibs that I have. And then you don't need many levels on NVIDIA because it's range trading. So again, that 116 is huge to me. Should have got long there yesterday, but unfortunately we didn't. And now we're kind of pushing back up into this cluster. So it's harder and harder for me to want to be long on NVIDIA. I am leaning slightly more bullish on chips, no denying, higher low, higher low, higher low. So NVIDIA's looking good, but this isn't where I was in NVIDIA until this last candle of the day. I ended up taking it again down here, but this wasn't a setup for me that I'd swing on, with data tomorrow. I mean, I might take the high risk lotto if there wasn't data tomorrow, but this isn't just quite a setup for me, just because we're going into all of this resistance. And so that's all I got. Those are the levels that I cared about today. So obviously, once we bounced them, again, looking to buy those dips and then short some rips. Cornbread, great question. And we're going to get into that. That's going to be one of the very first things that we talk about. Let me get this posted. Let me do a couple things real quick and then we will get to rolling. Okay. And cornbread, yeah, never a dumb question in my lectures, just to let you know. That's what I'm here for. Ask questions, The only way to get answers is to ask questions. So always feel free to ask them. Christian, how we doing? Another Christian, how we doing? Hope everybody's doing good. Welcome. Just doing one more thing real quick. Okay, and welcome everybody. Dirty River, happy to have you tonight. We are going to be talking some ETFs. There's something, everybody watches them, everybody talks about them. Pretty much all of us trade them. Maybe if you're a newer trader, you don't even quite realize that you're trading ETFs, but they are really just one of the most crucial things in the market. And so it's important that we understand them. And so that's what we're going to do tonight. This lecture, you guys know that I like to tie it. Uh, I'd like to tie it into charts. You guys know me. I mean, I love fundamental analysis, of course, but my big thing is charts. I love technical analysis. I love looking at charts. I love watching candles move. That's the side of the market that I'm into. So obviously tonight with our ETF lecture, we're going to be looking at charts a little bit. Not, we aren't going to be doing support and resistance. Obviously, if you have questions, feel free to ask them, but we aren't going to be doing, support, resistance, that kind of stuff tonight. We're more going to, talk bigger picture, how we can use certain charts to help us understand what other charts are going to do. And so that might sound a little bit confusing, but hopefully by the end of this, everybody will have it down. And so tonight, as I said earlier, we're talking ETFs. And so what is an ETF? Most people don't even know what an ETF is. It stands for Exchange Traded Fund. And what that means is, there's a few different types of ETFs. We're going to cover a few of them, but what it means is that it is giving you access to, a basket of stocks, a group of stocks, or a sector of the stock market, or even, there's some ETFs that we're going to get into, some of the last ones we're going to talk about that actually kind of, in a interesting roundabout way track the price of a commodity. And so tonight we're going to talk gold and silver, obviously at the end of it, or those will be the last ones we talk about. So an ETF can have, many faces, but what an ETF is actually giving us is easy access to the market. And so we aren't going to get too deep into history or anything like that, but we are going to talk a little bit about the histories of ETFs, what kind of made us start looking into creating these ETFs and why did we create them. And it really goes back to, that we wanted to create ETFs after a really bad day in the stock market. And so what that really bad day was it's known as Black Monday. If you've never looked it up, markets got absolutely obliterated for little to no reason. There's a lot of people out there that try to say, oh, people knew that it was coming and blah, blah, blah. But in my opinion, and you guys know me, I always try to just live in reality, love conspiracy theories, but still live in reality. And so what happened on Black Monday was the markets got obliterated because of stop orders being triggered. As weird as that sounds, because we think of it today where everything is on computers and blah, blah, blah. Well, in the 80s, a lot of these things, a lot of the options market, all of the futures markets were still what's known as open cry. So when you see those videos of people, in the CME in Chicago or in the NYSE, and it's a bunch of people screaming on the floor, waving papers around, well, what they're doing is they are partaking in the auction that is the stock market. They're saying, I want to buy this many lots of corn futures or S&P futures or whatever it may be. Well, there was a bunch of stop orders around in the late 80s as we're kind of moving towards more computerized trading. Well, the market started selling and then it continued selling because it kept hitting stop order after stop order. And so, I mean, there was nothing available to purchase and sell short. Like there weren't buyers, there was only sellers. And we also, you might hear the dumb bearish people, your Zacks and stuff talking about, oh, I want to limit down. Well, part of why Black Monday was so aggressive was because there was no such thing as a limit down. There was no halts on these major indexes or on these major commodities. So when the selling started, it just turns to panic. And so Black Monday was an accident, I mean, there was a little more going on, of course, but as a whole, Black Monday was an accident that resulted in like I don't remember, 25% decline in the Dow in a day. I mean, it was not a good thing, And so that's why they created halts. And I see your question, Christian. Yep, that's why they created halts. And so that had people worried, and it also had people with a want to have better control, because at the time the futures market was really, for an example, it was really the only way to get involvement in the S&P, the S&P 500, as a whole index. You did it through the futures market. So not everybody had access to the futures market. Not everybody wanted to take on that kind of risk. I mean, there was huge money made and lost back in the futures pits back in the day. And so people wanted access to it. And so a company that is known as State Street, they created the first ETF. And it was, I don't remember the date. Somebody can double check me on this, 93, 92, something like that. And they created the very first ETF. So that's kind of interesting to know. A lot of people think that SPY has been around forever, but in reality, SPY was the first ETF, and it was created in the early 90s. And it was a way to give the average investor access to the S&P 500 without the risk of trading in the futures market, or, the options market, derivative markets. It just kind of gave you access to all of the stocks. And so that's how our first ETF came about. And it was SPY, shout out SPY. We all love it. Greatest thing ever. And so that just progressed. And all of a sudden, they wanted ETFs for everything. And so, as we know, now there's a ton of ETFs. However, SPY, the original, the OG, the bread and butter of almost all traders. You guys hear me talk about it all the time. There's no large scale, very smart, very great traders that are trading SPX to make money. They trade SPY because they understand the math of the market. And so, because of that, SPY has become the most heavily traded ETF, the highest volume ETF, the most liquid options market that there is. I was talking about it with some friends today. There was over 1 million SPY contracts, same days, traded today. And so that's why we all trade it. That's where, big money is. It moves well, it pays well. The options market is extremely liquid. You don't have to be in your sketchy, oil trades. We're going to talk oil later, but you don't have to be in your widespread oil trades. You don't have to do that kind of stuff because we have SPY, So that is why it is number one. It has been number one. It's literally the first ETF. And so everybody trades it. And everybody at the very least watches it. So what is it? Because we've all heard it a million times, people saying, and this is getting into your questions, cornbread, six, everybody, this is getting into your question right here. So what is SPY and what is an exchange traded fund? After our little history lesson, it is just a basket of stocks. So it holds shares of specific companies, specifically companies in the S&P 500, the 500 largest companies around. And so it holds shares of these companies. And so we're going to do this with all the ETFs tonight. I'm going to kind of rush through them. The numbers aren't super important, but it holds shares of companies. So very common question, does SPY move the stocks or do the stocks move SPY? And it is 100%, no questions asked. If anybody tells you different, they are wrong. The stocks move SPY. SPY does not move the stocks. We notice, with all of our fancy data and everything that we have on computers now, you will notice that when SPY bounces, the other names bounce. But SPY is actually bouncing because the names in it are bouncing. And so how can we use this to our advantage? Because, this is kind of an offshoot from ETFs, but you might notice, and I hope you don't notice, and I hope you aren't trading SPX, but if you do, you might have noticed that, SPX is, it is around 10 times the value of SPY. However, we have SPX trading at 5,699. Well, if we just move this decimal place one to the right, we're $21 short of the, we're $21 short SPY to SPX. That is because the calculation is done differently. So on SPX, which is cash settled index, we're actually going to get a little bit more into these in another lecture. It's a cash settled index, can't trade it with shares. So it is all based on the market caps of the S&P 500 stocks, whereas SPY is based on the shares that it holds. So when we buy a share of SPY, say I want to go out, I want to buy a share of SPY. Well, you can look up and see what you're actually buying, see the companies that are held in the S&P and see how it's weighted. And so what is weighting? Well, SPX, like I said, it's calculated just on total market cap. That's it. There's no, Apple is worth more in there. Well, when we come to SPY, Apple is worth more. It's not equal weight. It's not all based on, it's not all based on market cap. It is based on what are the dudes at State Street like the most. So when we look at SPY, it's 7% Apple. It's 6.5% Microsoft, 6% Nvidia, 3% Amazon, 2 or 3% Google A, and another 2% Google B. And then Berkshire Hathaway is a really big holding in there. So those are what controls SPY. Obviously, there's, I listed 6 or 7 of them for us. So there's 493 other holdings in there. But when we look at SPY, we know that those top 10 names make up, 25%, 30% of the total ETF. So that's why when I trade and people frequently ask me, hey, what do you see on SPY? Or if we're in voice chat and somebody asks me, I might say something like, well, we got Apple, Microsoft, Nvidia all sitting at support. So I'm going to look for some calls on SPY. And why do I look at it that way? Because those stocks move SPY. So we're just going to show, and we're going to do this for kind of all of these tonight, a layout that people might like to, maybe look at if they're getting into trading SPY. So you might have 4 screens on your chart. Maybe you have more, you can lay these out however you want. I'm just using these ones. And you like to trade SPY. Well, over here, pull up your Apples, your Amazons, your Microsofts, and start looking at them. And you aren't necessarily trading these. And of course, over time, you'll get better at just glancing at things and saying to yourself, oh, I see this happening, so I'm going to trade it accordingly. So just as an example that I see right here, we have, and this is going into end of day, so whatever. I mean, we can kind of ignore it, but we're going to pretend it's not end of day. Well, I'm trading SPY. I've seen we've sold and bounced a little, but we're selling again. Well, I'm going to look here and I'm going to say, well, this actually kind of looks like potential maybe double bottom, maybe triple bottom sort of deal. We're holding the opening range, we're holding my level. And that's not enough for you to get into calls. We have this information that, yes, there's potentially a technical setup right here, but we know that we need some support for that technical setup. So what am I going to look at? I'm going to go look at these big names and I'm going to say, okay, hey, we got Microsoft setting a higher low. I'm going to zoom in on Apple and I'm going to say, oh, we actually got Apple holding support setting a higher low. And then if I come over here to Amazon, I can say, oh, we're selling right down to the huge level that we had earlier. You could probably even draw some sort of trend line on here. I'm sure that would probably make you say, maybe this is a 3-push wedge. So, and again, a higher low. So all of a sudden, SPY's selling, but we got some things setting a bunch of higher lows market wide. So I'm going to use all of these things to say, hey, I think SPY could bounce here. Because I have, just by looking at these 3 stocks right here, I am looking at 17% of SPY. So if all of these look like they could bounce, SPY can probably give us a bounce. And so that is how I use SPY. I use these major ETFs every single day. And that's how I trade SPY. That's why, when people ask me questions, if I don't have all of those things lining up, and giving me reason to be in the trade, then I'm not going to be in the trade. I get asked questions all day, every day. Hey, what do you think about this chart? Calls here, puts here. And, generally my answers are, not for me. But I'm not saying that just because I don't like your trade. I'm saying that because not everything is lining up. As I said, is this a reasonable enough pattern that people might say, hey, I like to trade double bottoms. We're holding opening range. We're holding this level. Sure. That's theoretically a good trade plan on an individual name. But if you don't have that backed up by these ETFs, then or by these names, then your ETF is not going to work. If you got Apple just dumping, if you got Microsoft dumping, if you got Amazon dumping, the market is dumping. That's how it's going to work. And so always use these other names for your confirmation. And again, when it comes to SPY, I personally watch Apple, Amazon, Microsoft, Nvidia. Maybe you want to watch Tesla, maybe you want to watch Google, maybe you want to watch those Berkshire Hathaway. B, obviously, no point in watching A. Maybe you want to watch Berkshire Hathaway, maybe you want to watch Meta. I don't trade those names, so I don't watch those names. But I trade Apple, Amazon, Microsoft, Nvidia, so I watch those names to pair them with SPY. And so that's what an ETF is. It holds a bunch of shares of companies. You can even look it up, and they will tell you the specific numbers of shares that are held in each of these ETFs. And so if you aren't looking at these and you're trying to trade the ETFs, then there's a very, very good chance that you're going to, a lot of the time, be having really, really bad entries. There's just no way around it. It makes, when we look at these other names, it makes it very, very easy to say, even if you enter a trade, these will tell you before SPY tells you that you're wrong. So they can be that signal, and I know I joke around with people a lot, but people are horrible at using stop losses in here. Well, if you are a person who's responsible, trades responsibly, doesn't hold, minus 80% trades or whatever it is, then you will see, okay, maybe you buy SPY calls because I do, and I do. I think this FOMC level is big, but just for the sake of description, maybe you buy SPY calls because we break it and we hold it. But then if we start looking over here and we see, well, Apple's starting to sell, Microsoft's starting to sell, Amazon's starting to sell, well, then we can look at the chart and very quickly say, okay, maybe I made a couple bucks. My stop is a close under this level because everything is selling. Support is below us. So market tracks between support and resistance, whatever you want to call it, but that's what it does. And so if we have a bunch of these things breaking down, and we know our support is, these previous highs, these previous lows on these names, we're likely tracking there. And so we know SPY is likely breaking down there. And so use these to your advantage. And so, yes, Six, I see your question. Oh, we got Norberto in the house, senior stock picker. Wrong side of the tracks lately, but he's trying. Yeah, is there a list of which stocks are in all of the ETFs? Yep. And then okay, so now that we've done SPY, now we're just going to kind of go through the other ones a little bit more quickly. As always, I like to try to leave 5 or 10 minutes at the ends of these classes for, checking out charts or any questions or anything like that. But so for this next little bit, we're going to go through some of the other ETFs that I watch, ones that I care about, and maybe ones that you might like to trade or something like that. We're going to talk about some of the larger holdings in them, but a bit more quickly. Just know that an ETF holds stocks or holds a commodity or anything like that. And if the stocks aren't moving, the ETF ain't moving. That's all there is to it. And so the next one that we're going to get into, and yeah, Six, there's lists of them everywhere. They're all over the place. But again, we're going to kind of cover some of the different ones. And one of them, you're going to see that, of course, SPY, if you want to go look at all the holdings, it's fun. Or QQQ, you want to look at all the holdings, it's fun. But then one of the ETFs, not technically an ETF, it's a trust. Then we're going to go look at the holdings of that one, and you'll realize they don't hold very much. So there's really only a couple companies that you need to watch. So next one we're going to talk about, obviously the second most important one, the ones that everybody cares about, or that everybody cares about these days, is QQQ. And so what is QQQ? Again, same thing as SPY. Holds a basket of stocks, a weighted basket of stocks. If you ever hear, me or Tilio or anybody talk about NQ or NDX, that's the whole tech sector. And so QQQ is the ETF for that tech sector. And so it's has holdings, it has weighted holdings, it actually has even heavier weighted holdings than SPY. But as we learned, SPY, 500 biggest companies in America based on market cap. So we know those are very big companies. Well, now we start looking at QQQ, and QQQ is tech. And as should be absolutely no surprise to anybody, the biggest companies in America are tech companies. And so, as you can imagine, the top holdings of SPY, Apple, Microsoft, Nvidia, Amazon. Well, the top holdings of QQQ, Apple, Microsoft, Nvidia, Broadcom. Those are the biggest holdings in there. Then you got Meta, Amazon, Tesla, Costco. Funny enough, Costco's in there too. But watch those same names. So you can do the same thing on QQQ. And if you're watching tech, then you will start to have a very, very good idea of what is going to happen with tech by watching these names. So again, and we're hindsight trading. Everything's way easier when you just get to look back and pretend that you're good at trading or whatever. But we see QQQ pushing up here to resistance. You can't just take a trade here, but this is even more clear than it was on SPY. We have QQQ coming up to resistance, setting a potential double top at this level. High days up here above us, and we failed it really nice, rejected it before. So we're looking for a rejection here. Well, when we come over here, yeah, we should also be looking for a rejection there, pushing up into EMAs, pushing up into VWAP, but solidly under VWAP, struggling above VWAP. Amazon maybe throwing us for the wild card, but nice push up. As soon as this one starts selling and gives up EMAs, that is where our confirmation starts to come. And as you can see, QQQ shortly after follows, and we get to see the selling. And so that is how I trade QQQ. Again, I watch Apple, Amazon, Microsoft, Nvidia. Those are the ones I like to watch. So when I'm trading SPY or QQQ, that is when I watch those stocks, always. It does not matter. It doesn't matter if I'm trading SPY or QQQ. Those are the ones that I'm watching. They can also, give you hints of, is a range day coming? Is anything like that? Are trend days coming? If everything's kind of ranging, then you can kind of look for a range day on your major ETFs and trade it accordingly. And so, that's QQQ. Again, like I said, we're going to go through these next ones a little bit more quickly. Some of them will slow down a little bit, but because QQQ is basically SPY these days, they're just the same big tech names, then we trade them the exact same. I personally trade QQQ less. It's a little bit less liquid. The contracts are a little bit more spready. We've had some lower volume in the market lately too. So getting in and out of QQQ can be slightly more difficult than SPY. On SPY, it is pretty dang easy to sell at the ask. On QQQ, it's a little bit more difficult to sell on the ask. However, they both trade really, really nice to it. SPY, again, the most liquid ETF around, and QQQ likely coming in a close second. So again, that's trading tech. If you're a big tech trader, have these names pulled up with you. Oh, FaZe in the house. How we doing, FaZe? Oh, of course, Norvin talking about China. Let's see. So futures calculations are interesting because a lot of it is coming from foreign data. And then the other thing that a lot of people don't realize is that, stocks are only closed for a short amount of time in the evening, and so, and things like SPY, actually, a lot of people don't realize this, but a main way that we catch paper traders if they're trading thinkorswim is when you look at a post of SPY, if somebody's ever posting gains of it, then it will have a little purple circle on it with a 24 inside of it. And what that means is it's actually tradable 24 hours. And so we're just getting that after hours data, and that's what's moving it. Obviously, the futures are being moved by those foreign markets mostly. There's not a lot of people in America that are up at 1 or 2 in the morning trading the S&P futures. That's mostly going to be foreign markets moving those around with some speculation on price movement. So it's actually pretty tricky math. You can look it up, but it's not as fluid and it's not as data, like there's not as much data as you get intraday. So obviously that's why I can move around a little bit more, because there's some speculation in other countries going on in our stock market. But then, Robinhood's the prime example that shows, and I still don't know why they did it, but they paid all that money to have some of those 24-hour markets open, because Apple shares are technically tradable 24 hours. You just got to find a market where they're trading. Can you use that SPY resistance as an indication to say that stocks are weak? No, but you can use the stocks coming up to the resistance to not say that stocks are weak, but that you could potentially see a pullback. You never want to be the person that's shorting QQQ at 483 saying we're going to 478, because everybody's going to make fun of you behind your back. However, if you're the person of your short in 483 saying, oh yeah, I'm looking for a scalp down to these recent highs, 482.30, then we're going to say good job. And you can say, we got Apple struggling, downtrending overall. We got Microsoft struggling, downtrending overall. We got Amazon trying to push up, but quickly giving up the previous highs. So maybe we are going to see some selling in QQQ. That's how you could use it, more than say QQQ is at resistance. Use the stocks to say, is QQQ going to reject or break the resistance? Okay, so that's tech. So any questions there? Any questions on tech? Obviously pretty simple. Pull up your favorite tech names, watch them, and use it to help you trade QQQ. Okay, so next one that we are going to talk about, and this one traded different. As as weird as that sounds, this is one that is traded different, and I personally mostly trade it very technically. Is there, even though I'm telling you to not do that on SPY and QQQ, you will see more of the reason of why on this next one. We can kind of trade it more on technicals. And what the next ETF we're talking about is IWM. And so what is IWM? It tracks the Russell 2000. A lot of people call it the rut. And it's small cap names. And it is quite literally 2,000 small cap names. So it doesn't have, that same sort of weighting going on that, say, QQQ or SPY or any of that stuff does. You got 9%, and I forgot to say these, 9% of QQQ is Apple, 8% is Microsoft, 7.5% is NVIDIA, 5.2% is Broadcom, and 5% is Meta, 5% is Amazon. So right there, you've got 30-40% of the ETF covered. And then you got Tesla and Costco on there, and you have most of the ETF percentage-wise covered. So that's what you can watch. IWM, very different boat. Tracks 2,000 stocks. And the largest holding in there is a company that I had never heard of. I mean, I know that it's an IWM. That's the extent of what I know about the company. And the largest holding in IWM is 0.4%. And it's Sprouts Farmers Markets. That's the #1 holding in IWM. So most of us just think of IWM as the small caps, as the rut. I'm not super concerned with what Sprout Farmers Market intraday is doing, or, any of these other ones, like I've never heard of this, but it's one of the largest holdings, and look, it's ripping, huge gap up, apparently. I've never heard of this company, so I don't watch it, and it only makes up 0.3% of the ETF. So IWM is one of the unique ones that, yes, it is going to trade by what the stocks are doing in it, but there is such a broad basket of stocks covered that it's very tricky to just say, oh, watch the top 10 holdings of IWM and it's going to track those, because the top 10 holdings of IWM make up maybe 1% of the total ETF, 2% of the total ETF. So it's not as simple and cut and dry as SPY and QQQ, where you can watch 3 or 4 names and you know what that market is going to do. IWM is one that obviously a bunch of people have their eyes on right now because rate cut environment. Everybody should have their eyes on IWM or some of those other small cap leverage names or anything like that, because they are who will benefit the most from rate cuts because they depend on debt. And so when debt becomes cheaper, these small cap, these, lower risk or like lower, debt appetite companies can suddenly take on more debt and actually grow the company and invest in themselves and do things. And so that's why obviously, when the first rate cut potentials were mentioned, it absolutely flew. And they jumped the gun on it, obviously, because it ended up taking us multiple months longer than expected to actually get those cuts. So they jumped the gun on it. But IWM definitely one that, when you look at the big picture, obviously still down well off the highs, has found some buying. I traded a lot, if you can't tell. Has found some buying off of these, after being in a range for 2.5 years. Has started to find some buying, will continue to find some buying more and more. Again, it's just one that I personally trade very, very technical. It trades very technical, and that is because it's tracking such a large basket of stocks that things just kind of line up. That's how stocks work. Things line up that you're going to be able to catch those bounces, catch those shorts, all of that stuff. And it's going to trade like it should trade. Oh, there you go, Mr. AMD. See, I live in the middle of nowhere, man. I don't know nothing. I mean, we got Mueller Industries, the Ensign Group, Fabrinet, Sprouts Farmers Market, a bunch of things I've never heard of. So again, very difficult one to track it. To just pick a few names and follow it. Obviously these names make moves. They're pretty liquid chains, but a lot of these names are trading at a decent enough valuation. Look, I looked this up. This is probably the last time I was trading or looking at this. And so again, IWM is just tracking those small caps, 2,000 of them, tracking the rut, and the rut is actually named after, it was some people in London that made up the rut, but so that's the rut. Nah, else ADD, well, so in a way, yes. It doesn't have the zero line, so obviously you aren't going to have a zero line, but it's telling you how are small caps doing as a whole, whereas ADD is telling us how's the NYSE doing. And, the NYSE happens to hold some SPY. So it's, ADD is very helpful to us. And so, in a way, yes, it's similar to ADD in that it's tracking the small caps, all 2,000 of them, or the major 2,000 of them for us. So in a way, yes. In another way, no. Okay, so that's IWM, small caps. Oh, we got Norberto talking in here. Oh, you get your sushi at Sprouts Farmer Market, huh? Nice. Okay, so next one that we're going to check out, and this is again broad market ETFs. That's how I don't know if that's the right terminology, but that's how I describe SPY, QQQ, IWM, and now the final one that we're talking about. And there's more than this. There's tons of ETFs. There's ETFs for everything. The final one that we're going to talk about is DIA. And so it tracks the Dow Jones Industrial Average, which is, it's talked about less these days by the new retail trader crowd. However, the old timers, people that started trading, not in the last few years, the Dow is what you watch to have a better idea of how are we doing. Something that I always teach, and that it is the absolute fact and you cannot deny it, the stock market is not the economy, obviously. Well, the Dow gives us a truly unbelievable view into how is things going business wide in America. They hold, your classic blue chip stocks, safe names, names that have been around forever, generally speaking, pretty valuable names. They've had, of course, a few names in there that have had some issues in the past, but as a whole, they are tracking just tried and true good American company names. That is what the Dow is tracking. So it will a lot of the time be a leader when things are going well. It can be a laggard for when things start to go bad, or it can be a leader for when things start to go bad. So, just interesting to know. SPY obviously has put in just some really insane moves for us off of those lows. Well, so has the Dow. The Dow was setting new all-time highs long before SPY was setting new all-time highs. Obviously, QQQ is still off all-time highs. The Dow was the leader for most of this rally. I mean, when you come back here, like this type of move on the Dow, it was frequently setting those new highs once things started picking up before SPY was setting the new highs. And so it gives us that good view of the market, safe, old, reliable companies. And so their largest holdings, United Health, obviously gigantic, huge company, safe company, makes up 9% of DIA. Again, DIA is the Dow. The old timers call it the diamonds. If you ever hear somebody talk about the diamonds, that's DIA. And so holds United Health, holds Goldman Sachs, Microsoft, Home Depot, Caterpillar, McDonald's, Visa, American Express. It holds household names. And again, it is one that you can trade it technically, of course, and you should always take notes of major breakouts, all-time highs, things like that on something like DIA, but it falls into that very similar category of SPY and QQQ. You get United Health, Goldman Sachs, Microsoft, Home Depot, Cat, you have now covered a very, very large chunk of that. And so because you can look at just a few names, then uh, you know, because you can look at just a few names, you can really have a pretty good idea of what the Dow is going to do. You can also give the Dow, it really respects the fundamental overall view of the American economy. And, a lot of people don't want to hear it, or they don't see it, or maybe they just aren't feeling it right now. The American economy, the job market, everything is doing very, very good. And the Dow shows us that. And so again, nothing in the stock market represents the economy, but if you had to pick one to kind of watch and say, how is America doing? Watch the Dow, watch DIA, and that's going to tell you how just some really good old safe companies will perform, and how are we doing as a whole? So that's the Dow. Let's see if we got any questions. Yeah, NYSE and NASDAQ are separate. There's overlaps of holdings. I mean, the lines are getting blurred. And so, again, so who issues things? What are they issuing them on? Those can all kind of vary. QQQ is issued through iShares, SPY is issued through State Street, QQQ is on the NASDAQ, but is also traded through the NYSE. You see it come up on the tape in the NYSE. So the lines of NYSE, NASDAQ are getting more and more blurred as time goes on. But generally what people like to think is, NASDAQ is more techie, NYSE is more broad, but that's only partially true. I think like Costco, I believe, trades on the NASDAQ and it's in QQQ. And so, I mean, is Costco tech? I don't know, maybe. Is VST going to be out of the Dow? I highly doubt that. Okay, so we're good. So now next ones we're going to talk about a little bit quicker, but things that I watch every single day. So the first one that we're going to talk about, these are, we were looking at broad market ETFs, your Dow, your QQQ, your SPYs. So the next thing that we're going to check out is some sector ETFs. And we're only going to touch on the two that I watch because I watch them all the time. I mention them, people trade them. And so what do I mean by sector ETFs? The S&P SPY is actually split up into 11 sectors. They got communications, industrials, and then, the ones we're going to talk tonight, energy and financials. So the first one we're pulling up is XLE. This is one, I don't trade oil. I don't trade those names. I hate oil because it is entirely too news driven. As you can see, the XLE ETF, other than when things are going bad, it spends its whole life in a range. I do like trading ranges, but I don't like trading oil long. That's just me personally. So what is XLE? It's the energy sector of SPY. But it's a very, or I don't want to, it's not very, but it's a unique one. And it's a very easy one to trade. And I don't people struggle with it, but they should not struggle with it. Why is XLE easy to trade? Because it holds very few companies. It holds, I think off the top of my head, 20 or 25 companies. Well, the top, I don't know, 5, 10 companies make up like 80% of the ETF. So what does it hold? It holds things, XOM, it holds, your Exxons, it holds Chevron, it holds Marathon Petroleum, Phillips 66. It holds your oil companies. We got a few, solar companies slash oil companies sneaking their way in there, but it tracks the energy names. And so when you trade something like XLE, you only need to watch, two charts. I mean, XOM is 23.6%. Chevron is 16.75%. You don't need to watch much more. So that was why, I mean, everybody was trying to trade XOM and everybody's buying XOM at 116. And I'm like, you guys are out of your minds. Buy it at 113 or trying to long it at 118, short it at 118 and 120 because these things trade very range bound. Well, why do I hate them? Because these bad traders, the ones who are trying to trade XOM at this 116, 115 level, well, they buy calls, they get blown out 60, 70%, then they get to celebrate in profits and say, I told you so. It can also go the other way. Maybe they short it, oh, we're shorting 116, and then it flies above it, and then it ends up dropping, and they get to say, I told you so. So I don't like to trade these things that, reward bad trading. And that's what oil does. Oil is so news driven that you have, huge gaps up, huge gaps down, and you trade in just these gigantic ranges. And we see it on XLE. Well, if you're trading XLE and you pull up XOM and Chevron, like, you're covering 30, 40% of the ETF. If those two are going up, XLE is going to go up. So very simple to trade. Oil is, I mean, other than the news, oil is very simple to trade. There's really never any reason to get blown out on an oil trade. I don't know why people do all the time, but they trade in ranges almost exclusively, the energy names. And so you buy dips and you short rips always on those names. Do you have the off chance of getting blown out one way or the other? Sure, but it's never going to be too bad. And you just have to respect that stop. So again, if you want to trade the XLE, watch a couple of oil names and your life is easy. Very easy ETF to trade. So next one we're going to talk, again, we're just kind of cruising through these ones. XLF. XLF, slightly different because it does have more holdings. I don't remember off the top of my head, 60, 70, something like that. And it tracks financials. So obviously financials is big business in America. So it makes sense that, 10, 15% of the S&P is going to be financial stuff because that's, it's big business in America. So obviously they're going to be really good. Well, again, what does XLF track? You have a few very large holdings in there that you can get a pretty dang good idea of where XLF is going to go. Largest holding, Berkshire Hathaway, B, of course, not A. If anybody's ever talking Berkshire Hathaway, they're talking the Class B shares, not the Class A shares. Berkshire Hathaway, 13.6%, JPM, 10.2%, Visa, 6.8%, MasterCard, 6.8%, Bank of America, 4.5%, Wells Fargo, 3%. So you can watch, again, just a few names and have a pretty dang good idea of what XLF is going to do. Again, it tracks the financial names. It's got decent liquidity. It's a pretty nice trader. It's a cheaper ETF, so you can always buy those, in the money contracts to really maximize your delta. XLF, a nice one to trade. I personally only short it. I won't long XLF, but ethically, but long it all you want. Obviously, financials are strong, but very easy one to track because again, you pick, if you got Berkshire Hathaway, JP Morgan, Visa, and MasterCard pulled up, you have now covered 35, 40% of the ETF again. So you have a very good idea of where it's going to track. Again, as we've learned, ETFs move with stocks. Stocks don't move because of ETFs. ETFs move because of stocks. So financials, if that's your thing. And that's why I want to do all these things, all these different ETFs, because you don't have to trade SPY, you don't have to trade QQQ. Find some of these that you like to trade and trade them. And so, final one that we're going to talk, because we've talked about broad market ETFs, we've talked about sector ETFs, and oh, Christina, just DM me. I don't have a list of I don't have a list of all of them, but I can send you. I got you covered. You don't even worry about it. Piece of cake. So very last one that we're going to talk about is GLD. Obviously gold. It's the gold ETF, gold shares ETF, and this is a unique one. It's not a broad market one. It's not a. Technically, it could be a sector. It's the gold sector, but it is tracking the price of gold. However, it is doing it in a very, very interesting way. The math we aren't going to get into, but GLD is the ETF that is directly tied to the price of gold. So, as we see, if anybody doesn't know, GC, this is the gold futures. If you ever want to look at gold futures and see how the price of gold is doing, then obviously it's absolutely rallying. It's doing very, very well. Well, if you pull up something like this, gold, this is the gold miners. And you can see far underperforming the move that gold is making, or GC is making, but so really underperforming that, and then really underperforming what GLD, the ETF, is doing as well. And so GLD, why it was, and I won't say this is specifically why it was created, but as investors, most people, most people don't want to buy a bunch of gold, have to pay to store it. It's big, it's heavy. So they don't want to buy gold. They don't want to pay to have to store it. They don't want to pay to insure it. So you invest in GLD. Well, what is GLD? The company that issues GLD, and again, anybody feel free, a lot of time when I'm saying numbers, they're coming off the top of my head. So always feel free to, price check me. But I think they hold about 40 million, 30 million ounces of gold. So this price of GLD is really moving. It's obviously a fraction of the holdings, their total holdings, but it is moving based on the value of gold, because this, the GLD trust is, they are saying we hold physical gold to back this up. And then they do some fancy math. And from their holdings, this is based on the value of gold. So it is tracking a commodity. We aren't going to pull it up. SLV, the same thing. It is tracking the price of a commodity, but it gives us as an investor, we can invest in gold without having to go buy ounces of gold and, like I said, deal with storage, deal with insurance, deal with all of that. And so it's a very, very great one to watch. Very great one to trade, cheaper ETF. The issue we're looking at now with gold is that it is and always has been a big fundamental mover. So that's where you can kind of get you can get a little, it can get away from you if you don't understand the fundamentals behind it. But as a whole, gold's going and going. It's going to see 250. I would like to see a pullback, but it's definitely an area to remain bullish on. Yeah, so, and then let's see. So final one we're talking tonight. And this is I don't trade it. I look at it and I use it. Again, this is one that I do not trade. I only use it as a way to analyze the market. It's kind of, not everybody likes to look at it. I mean, I think the only two people that I've ever heard talk about it until we talked about it is me and Tilio. And what is that? And it's RSP. And so what is RSP? It is the equal weighted S&P. So remember, we have SPX that is calculated by market cap. We got futures, which are actually also calculated by market cap, but a little bit different. Then we have SPY, which tracks SPY, but heavily weighted towards your big tech names. And so what is RSP? It is equal weight. Nobody is worth more than anybody else. And so what this shows us and what I use it for, I don't pay attention to it in short time frames. I use it to understand market breadth. And what is market breadth? Is all the money focused one place or is it focused in a bunch of places? So, when we saw, most of the big rally, not most of it, but a lot of the big rally in 2022 was tech names. So RSP, it was rallying, but it would it would rally less than say SPY would or less than QQQ would on a day-to-day basis because it's equal weight. Like it's happy text going up, but it needs everything to start going up. And so that's what we saw when they finally started mentioning those rate cuts, the first mentions of rate cuts coming that end of 2023 and it ended up being a dovish pause, it ended up being a dovish pause, seemed hawkish pause in the beginning, but dovish pause. And that's when it really started rallying. And then obviously, we're up the better part of 50% since in a year. So that was when RSP really started kicking it in. And so again, this is just equal weight. I use it to say, is money focused one place or is money going to multiple places? What a push up to that 161.8, huh? Okay, so that is it. We got 3 minutes left. Of course, we can do a little. Oh yeah, getting a lot of questions about this. So make sure, will you guys all DM me tomorrow and I'll send you guys some lists of some things. What are miners? So in gold miners, they're literally mining companies that are out there mining gold. In crypto, they're mining crypto. And it's dealing with the same thing right now too, in my opinion, and I called this one out a long time ago. We got Mara absolutely throttled. And what major thing happened in here? Bitcoin ETFs. And as an investor, why would you want to be in a miner when you can have direct exposure to the asset? And so we're seeing the same thing in Mara. We're seeing the same thing in Riot. These things are destroyed. They're getting killed by halving. And so we had the halving, and then we have Bitcoin ETFs. And any big money person, why would they be in a miner that has all these expensive when you can just take direct exposure to Bitcoin through an ETF? So I called this one out a long time ago, whenever that was, April, somewhere whenever that halving came around or it started being discussed, and then the Bitcoin ETFs were released. I said there's no reason to be long on miners anymore, and it's definitely played out so far. Do we look at RSP? Yes, we do. SK just did it. Nice. 6. So that requirement came from just the beginnings of that online trading stuff, like when E-Trade was coming out in the early 2000s. And it was all due to margin requirements. And it's something that we've just fallen behind on because, most other countries at this point, like Canada and everybody, they're all instant settlement. Whereas the US is just going to T+1, like it used to take 2 days for like just a few months ago. It took 2 days for sold shares to settle. That is ridiculous. Everywhere else is instant settlement. So it's just leftovers from earlier days. I mean, it's dumb, but that's why everybody offers a cash account now. That's why, your TDA offers cash accounts. Webull, Robinhood, they all got cash accounts. iBroker, Interactive Broker, they actually do instant settlement even for Americans. Oh yeah, MSTR. I mean, of course, that's one you don't want to bet against because I mean, Sailor's smart and he holds a ton of Bitcoin. So it's one that, and before you could trade the miners very well next to the Bitcoin chart. Well, now here's your micro strategy, here's Bitcoin. See how they look the same? That's because you're investing in Bitcoin when you're investing in MicroStrategy. So that's why the charts look the same. And this is Bitcoin futures, so the price is different than the actual Bitcoin price. Then you compare it to something like Mara that is destroyed, or you compare it to something like Riot that is absolutely destroyed. CLSK, I called this one from a mile. It was a scam. Knew that one. All destroyed because why would you own that when you can directly access Bitcoin now? Oh yeah, should we look at yours, Norberto? I wonder if I lost it. Oh, I probably did lose it. Oh no, this is the one. Coin rallying. Um, let's see. I need a little more time. We'll give you a little shout out to Norberto when he was in his prime. Right down here. Look at this. This was when he was calling it. I jokingly drew this arrow up and put banger stock because that's what Norberto said all the time. When he was saying it down here, and then we rallied, and then here we are. I mean, we're up huge, 300%. Okay, so if that is gonna do it, thank you everybody for being here. Smaller crowd tonight. Love to teach about the ETFs to the diehard learners. Thank you everybody who always comes. Happy to have you. Yeah, VST just flying. I know. I don't know why. I still don't know what this company does. Yeah, thank you everybody. Thank you so much. Yep, thank you everybody. Thank you, thank you. Dang, we had AJ in the house. Is that AJ, Gail, Els, everybody? Thank you all. Thank you so much for being here. And we'll catch y'all tomorrow, Friday. Trade safe, have some fun, and we'll see you all then. Have a good night.